How's everybody doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on what's going on with the Synapse Financial Technology bankruptcy. So I've got two articles that we're going to look at from the Wall Street Journal. The one article I've actually been saving for a little while because it kind of explains the flow of money from the fintech to Synapse as the middleman or middle person, if you will, and then the flow to the banks. And we're going to show that and kind of give a better explanation as to how this whole system worked. But then the second article is the far juicier article. So I hope you will wait for that. That's where we're going to talk about the convening of a grand jury to investigate potential and alleged fraudulent conduct on the part of certain individuals at Synapse, and thus looking into the bankruptcy of Synapse Financial Technology and the potential fraud of $100 million in missing funds. So let's jump into these articles here. This is the second article. Let's take a look at this first. So the first article here is called "The Bank Behind the Fintech Revolution Stumbles After Customer Funds Go Missing," and this is from back at the end of December. So this is about 3 months old now. But it says Evolve Bank at its peak managed around $10 billion for financial technology firms, but it is in turmoil following collapse of middleman Synapse. Scott Lenore turned a sleepy farming bank in Arkansas into one of Silicon Valley's top financial partners. Now it is in crisis mode, and some clients have started pulling funds after a business partner failed and thousands of customers couldn't access their money. Evolve Bank at its peak managed around $10 billion for financial technology firms, including Stripe and Affirm. It caters to fintechs that offer technology-friendly savings accounts for everyday people with sweeteners like high interest rates. Most fintechs don't hold their customers' funds and instead use banks like Evolve in the background. Problems at the bank spilled into the open when a software company called Synapse went bankrupt in April of last year, April 2024. Synapse connected fintechs to banks like Evolve to store their customers' funds. Synapse's job was to ensure that everyone's funds were accounted for, while Evolve would open accounts and issue debt cards to the customers. The funds of over 100,000 fintech customers were kept in large, commingled accounts under Synapse management at Evolve, its primary bank partner for years. After Synapse filed for bankruptcy, thousands of customers suddenly couldn't use their debit cards or move money out of their accounts at Evolve. Evolve stopped processing payments and said it needed to determine how to distribute funds to customers. A month later, a court-appointed mediator disclosed that as much as $96 million in fintech customer funds might be missing from accounts at Evolve and other banks. Now, Evolve is facing lawsuits over the missing funds, and some clients are starting to back away from the bank. Both Evolve and Synapse blame each other for the misplaced funds. Synapse failed to do the most critical job they were supposed to do: keep accurate ledgers to track individuals' end user funds. Evolve said in a statement, it said it is working with other banks to find the funds. Synapse founder Sanket Pathak said in a statement that Evolve's inability to pay customers cast doubt on the safety and security of the financial system. The bank, which is privately owned, remains well capitalized and has ample funds, according to a statement last month from Lenore, the chairman. The missing funds show how Silicon Valley's push to revolutionize consumer finance hasn't quite lived up to its lofty expectations. While fintechs proclaim themselves as new banking products, many aren't actually banks and rely instead on old-fashioned lenders like Evolve. Even though Evolve is insured by the FDIC, the bank isn't the one that failed, so deposit insurance doesn't apply. So now let's take a look. So there's a chart here, basically says the flow of customers' funds involving Synapse Technologies and Evolve Bank. So first, fintechs, think of somebody like Chime, right? So fintechs make savings apps and offer banking services with sweeteners like high savings rates, but they generally don't hold or invest the client's money. So it goes through the fintech, and then it gets to Synapse, a middleware company, acting as an intermediary, helping fintechs migrate and store customer funds at banks like Evolve. Synapse did this for multiple fintechs. Okay, so now it moves through Synapse, and now it gets down to the bank. So in this case, Evolve. So Evolve Bank maintained several accounts for Synapse on behalf of customers. The primary Synapse account was a commingled account where funds were stored on behalf of thousands of people using multiple fintechs. So that's kind of the chart there as to how this thing progressed. But now let's look back. Now let's continue on here. So Lorena Biculima signed up with Juno, a Synapse customer, which offered to pay her 5% interest on her cash deposits. She put approximately $130,000 into an account with a routing number belonging to Evolve Bank. When she tried to use those funds in May to make a down payment on a house, she couldn't access the money. In late November, Evolve told Beculima it only had $1,182 in her name. I thought my funds would be safe because they were in an FDI insured account. Yeah, no. Nobody has been standing up for us. In my opinion, everyone involved is responsible. So, and then it goes on to boom times on Beale Street. Lenore and a small group of investors bought what became Evolve Bank in 2005. For around a decade, it grew by catering to businesses and consumers in the Memphis region. In 2007, he hitched the bank's fortunes to Silicon Valley and Synapse. Pathak felt banking in America was still stuck in the analog era where he moved from India. He started Synapse from his apartment in 2014, moved to San Francisco, and began working with startups that were looking to offer software-enabled savings products. Pathak needed to find a bank to work with him and reached out to Lenore, whom he had met through an acquaintance while attending the University of Memphis. Over a few days in Memphis, the pair hammered out an agreement. Synapse channeled around $10 million of deposits into the bank in 2017. By 2020, it was sending Evolve billions of dollars in fintech deposits. So the downturn around 2020, Lenore began questioning if Synapse was a necessary middleman to amass deposits from fintechs. Mercury, a fintech company that helped early stage startups manage their finances, started negotiating with Evolve about working directly with the bank. Robert Gonzalez, Mercury's general counsel, said in a statement that Synapse was not a reliable or trustworthy partner, and that led them to leave Synapse to protect our customers. On September 25th, 2023, Mercury said that it planned to move around $3 billion of deposits from Synapse account to its own account at Evolve, according to correspondence between Synapse and Evolve by the Wall Street Journal. The same day, Evolve sent Synapse a breach of contract notice, ending its relationship with the middleman, claiming there were funds missing from the accounts where Synapse kept fintech customers' savings. It isn't clear where the funds went, but there were discrepancies in the accounts holding customer funds because of several transfers over the years. In the summer of 2020, Synapse moved approximately $60 million of customer funds and placed them in a new account for its own use at Lineage Bank, a small bank in Tennessee. Meanwhile, Evolve had been charging fees directly from the Synapse customer accounts to pay itself and to cover card fees, according to bank statements. Those fees totaled about $26 million between 2019 and 2023. Pathak told Lenore the shortfall of customers' funds was Evolve's fault, citing the fee charges that he said were authorized according to the September correspondence. Evolve has disputed that the fee charges were unauthorized and said they are unrelated to the current missing funds. Lenore has also said there is no shortfall of funds at Evolve. Lineage said it has restored to customers 95% of Synapse funds it holds. So, and then it gets, and then it kind of ends here with, Silicon Valley leaves. So basically, this turned into a hot mess, and I think there were potentially some fraudulent things going on here, but there was also a little bit of greed at play. Evolve basically sat there and said, "Hey, you know what? Mercury comes in, says, hey, we can do a little bit better for you than Synapse." So again, is kind of, I think there's a little bit of backstabbing, a little double dealing going on here. But like I said, let's roll back to this article first. So, Synapse executive alerted accountants before 100 million missing funds scandal. So, former executive testifies before a New York grand jury investigating fraud and other possible felonies. So, a grand jury is investigating criminal misconduct at a Silicon Valley fintech firm where customer funds went missing and has questioned an executive who raised alarms before the company collapsed, people familiar with the matter said. Synapse connected financial technology firms with banks, helping startups that marketed flashy savings apps find a place to park their digital customers' funds. The middleman managed billions of dollars at its peak before its sudden collapse in April left thousands of people unable to access their money. A court-appointed mediator later disclosed that as much as $96 million in customer funds managed by Synapse might be missing, and some people have reported losing their life savings. The scandal is now in the crosshairs of federal prosecutors in New York. Victor Medeiros, who was a senior director in Synapse's finance department, was subpoenaed in November as part of a criminal investigation into fraud and other possible felonies, according to court records published in January. In 2023, Medeiros had told Synapse's accountants at Kroll that there was a shortfall of millions of dollars from customers' accounts. People familiar with the matter said. He said the gap was the result of Synapse keeping some of their funds for itself. The debacle has been a wake-up call for customers using smartphone apps that market themselves as alternatives to traditional savings accounts, promising above-market interest rates and deposit insurance. Even though Synapse's bank partners are insured by the FDIC, the banks aren't the ones that failed, so deposit insurance doesn't apply for the customers whose funds have gone missing. Synapse chief executive has accused its primary bank partner, Evolve Bank, of mishandling customer funds. Evolve has said the fault lies with Synapse. Evolve Bank normally paid Synapse interest on the deposits it held at the bank, much like any bank would. Synapse would then take a cut of that payment as a fee and allocate the rest to customers who were earning interest on their savings through apps like Yoda and Yield Street. About a year before Synapse's bankruptcy, Medeiros told Kroll that the firm hadn't been filling customers' accounts with the full interest they were due, leaving them more than $3 million short as of the middle of 2023. People familiar with the matter said. He transferred some of Synapse's own funds to try to bridge the gap, but told Kroll that there was still a $3 million shortfall, some of the people said. Well, think about this for a second, right? So, okay, they're promising the customer, Synapse, or the fintech maybe is promising the customer that they're going to pay them 5% interest on their savings account, right? So then it goes to Synapse, which Synapse, obviously acting as the intermediary, the middleman, they want to get paid a fee for their services. That's how they make money. So then it goes to Evolve. Now the funds get placed at Evolve, but say the fintech is promising the customer 5%, but the bank is only paying 4%. So now you have a 1% difference there. So now the interest gets paid from Evolve back to Synapse, but now, wait for it, Synapse wants to take out their fee. So now they take out their fee from it. So now 4% is not going back to the fintech. Now it's maybe it might only be 3% or 3.5%. So now you thus have created this massive shortfall. But now the fintech is going to Synapse. Hey, we need to get this money back to them. And Synapse doesn't have all the money to pay back to them. So you could see how this thing was a cluster and how it was going to go bad from the start. And then you have these apps like Yoda and Yield Street basically claiming or projecting that they have FDIC insurance when they do not, and thus misleading a lot of potential customers out there. So then it basically goes on to say, like, a year before Synapse's bankruptcy, Medeiros told Kroll that the firm hadn't been filling customers' accounts with the full interest they were due, leaving them more than $3 million short as of the middle of 2023. People familiar with the matter said. He transferred some of Synapse's own funds to try to bridge the gap, but told Kroll that there was still a $3 million shortfall, some of the people said. Kroll's employees checked Synapse's books and informed its board of directors that Medeiros' estimated shortfall was accurate. The people familiar with the matter said the board demanded the shortfall be immediately fixed, but Synapse was already running out of money and said it couldn't cover all the losses. In a letter dated September 23rd, 2023, Synapse CEO Sanket Pathak wrote to Evolve Bank executives that it appears that Synapse may have incorrectly received $3.25 million from customers' accounts, according to a copy of the email reviewed by the Wall Street Journal. He asked the bank to help cover some of the shortfall, according to the email. Evolve said in the midst of a deepening dispute with Synapse, but agreed to cover about half of the shortfall, according to a copy of the contract between the companies reviewed by the Journal. Synapse covered the other half of the shortfall, people familiar with the matter said. So now you begin to see the rift, and where in the first article we discussed how Mercury came into the picture. This is how it came into the picture. Synapse comes back. You come back to a bank and say, hey, we need you to give us $3.25 million. Yeah, that's not going to go well. So they, agreed to meet him halfway and gave him half the money. But still, your relationship at that point is basically ruined. So so you can see how a lot of this stuff began to unfold here. So Angela Strange, a general partner at Anderson Horowitz, left Synapse's board shortly after the incident. The people with the matter said executives from Evolve and Synapse still suspect there were millions more in missing customer funds and spent the next several months trying to get a grasp on the scale of the problem. The journal reported Kroll never finished its work auditing Synapse's finances because Synapse ran out of money to pay for its work. Very coincidental there. Kroll declined to comment. The grand jury is investigating the specifics of the $3 million shortfall as well as other issues, including some $26 million in card fees that Evolve charged directly from the Synapse customer accounts. A person familiar with the matter said it is also homing in on a specific communications from Synapse executives. The person said Evolve Bank has faced regulatory scrutiny since the Synapse debacle started. Last year, Evolve nearly lost access to FedWire, the Federal Reserve's primary payments network, as it faced pushback from bank supervisors over its internal controls. People familiar with the matter said in January, the bank's chief executive announced he was leaving his role, and the bank said it was closing parts of its mortgage business. So there you have it. Still, unfortunately, at the end of the day, this is still a hot mess, this whole thing, this whole situation with Synapse, and we will continue to watch this and see how it unfolds. Obviously, if the grand jury has been convened, some people eventually, you would think, are going to get charged with something here. But still, we still have to say, this is all still alleged. It's still allegedly, nobody's been convicted of anything here. So we shall see what happens. But there's no doubt that this eventually will come to trial. We'll get more stories on this in the future, and I'm sure there will be more juicy tidbits that will roll out as this thing goes to trial and we get more disclosure on the things that happen here. The big question is what happens to the customers? Do the customers made whole? Do they get all their money back at the end of the day? That's the big question here. So, but okay, I'll wrap up by saying if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the episodes on the channel. And I hope everyone has a wonderful day out there. And I'll see everybody again real soon. Thanks a lot.